latest in our instalments of the AFA COVID-19 webinar series. It's a pleasure to be here and to welcome you here today. I hope you're all sitting safe at home. As you can see, likewise, I just happen to have an AFA banner sitting at home, which is convenient for me. But look, really important, we've seen some stimulus package, a number of stimulus packages released in the last few weeks. And it's a lot to digest. It's great to see the government on the front foot in relation to stimulating the economy and keeping things going during this pandemic. But it's important to understand how that impacts you and how it impacts your clients. And it's a pleasure to have Adam Crabbe from Zurich Financial Services here today to unpack that and explain how it works for you and your clients. And we've seen some really positive signs across the board as well. You would have seen on Tuesday an announcement from ASIC regarding some flexibility around the use of our ROAs, the timing for time-critical advice and statements of advice. And just a few areas where it's obvious, two things became obvious to me. One, the government has recognised the value of advice, particularly at this critical time. And secondly, the importance of key stakeholders getting together and seeing what they can do to make sure advice is more affordable and more accessible. And that's great for right now, but it'll also pass through into what I think will be a future developments in advice. But for now, the important thing is unpacking the stimulus package. Adam Crabbe has over 25 years experience in financial services as a fellow of FinSIA, a regular lecturer at Securities Institute and Kaplan. And it's a real pleasure to bring him here today and to talk to you on behalf of Zurich. So please welcome Adam.
Thank you, Phil. And wherever you're listening, thank you for joining us today in this session where, as Phil mentioned, over the next sort of half an hour or so, I'm going to be unpacking a number of these government stimulus measures in response to this COVID-19 coronavirus pandemic. Now, I do hope to take questions as we go through today's session, so please feel free to use the chat functionality. And what I'll do is I'll do my best to address them as they pop up, or at least to try and review them, time permitting, towards the end of the session. Now, for those of you who perhaps are somewhat new to Zoom, what you may notice is the imagery there on the right-hand side. And if you wanted to really maximize the screen presence on your computers, what I'd suggest that you do is just to click on the flat ellipsis button, and that should help to drop down a number of the images that might otherwise be obscuring your view. Now, you'd certainly agree that we certainly are in a period of great disruption. In fact, since COVID-19 arrived in Australia, there has been a sizable shift, not only in the way that we live our life, but certainly the economy as a whole. And this pandemic has understandably been the source of great interest. And certainly our focus on this session will really be unpacking many of these financial measures which have been announced over recent weeks. Now, before we begin, I want to note that the information contained in the session today has been based on announcements and research as at early April this year. So any future measures, financial packages or changes perhaps to those which have already been announced, they certainly won't be forming part of today's session. Equally, some have not yet made it and become law, so they still are subject to some minor tweakage. But be sure to stay tuned to the end of today's session, and what I'll be doing is providing details on some tools, as well as some other resources, including some other sessions that are going to be available covering this particular topic. Now, this pandemic is becoming one of the greatest health disruptors in the world, really, since the 1918 influenza outbreak, which between 1918 and 1919 went on to infect around 1/3 of the world's total population. Now, while a lot has changed in the last 100 years, advancements in medicines being one that springs to mind, it's understandable that countries today are taking quite a strong measure in terms of really trying to curb the spread of this latest coronavirus. As you know, vaccines still are unavailable. What we do know is that governments around the world have begun taking quite serious steps to really help limit any financial toll. And the way they've really been doing that is injecting various measures into their own economies. Certainly here in Australia, and prior to the release of the first couple of stimulus packages back in March, the All Ordinary shed over 30% in a matter of just a couple of weeks. And by the time the second and the most significant stimulus measure was announced around that JobKeeper package, the market had rebounded by over 18% in just a fortnight. So these financial packages clearly have played a very critical role. And today we're going to spend some time understanding many of them. But more than that, what I want to make sure is that we cover many of the advice, considerations, and opportunities to really help your clients navigate this ever-changing landscape. Now, you have to agree, this is certainly one of the constants that we've seen of late is definitely change. And in fact, various announcements and measures that have been made have tried to target a number of different areas, including individuals, households, businesses, even industries and regions. And it does beg the question, are we going to see more? Will there be more to come? So what we do know is that early indications seem to suggest that the increase in interest from clients has been sizable around these government announcements. So before we unpack some of these key measures, what I wanted to do was actually share with you one particular government initiative that's been announced for business, which has been released not from the federal government, but at a state level. On the 3rd of April, the New South Wales state government announced their own economic stimulus package, something I know many other states and territories have also taken action on. But why I thought I might mention this to you is that from tomorrow, the 17th of April, eligible small businesses in New South Wales across a large number of industries will get access to a grant of $10,000. Now, the purpose of this grant is for funding, in the words of the government, unavoidable business costs. Now, there are 4 noted examples given by the New South Wales government on what these sorts of costs include, one of which is actually financial advice. The others are legal costs, utilities, and overheads. So for those of you who are listening who do have clients in small business, running a small business yourself based in New South Wales, those that perhaps have been highly impacted by the COVID-19 pandemic, it could be restaurants, retail, shops, recreation areas. There could be a real opportunity for you to raise awareness and really assist in highlighting this funding arrangement as being available, as I say, which goes live from tomorrow. If you head to the Service New South Wales website, which is service.nsw.gov.au, you'll find that clients will be able to gain access to the application for this particular benefit. Now, if you're curious what constitutes an eligible business, it is fairly wide ranging. So it does include businesses which have fewer than 19 staff, a turnover of more than $75,000, a payroll tax threshold in New South Wales below $900,000, be based in New South Wales, and employ staff as at the 1st of March this year. Now, look, apologies to other states, but I thought, as I say, it may be worth mentioning that certainly for those in New South Wales where it could be of interest, but equally, if you're outside of New South Wales, this could be a terrific talking point with your own local Member of Parliament. Maybe to share with them what New South Wales is doing through their small business support grant that extends help to fund the cost of financial advice in this current period, and perhaps similar moves may be made available for you and your clients. So I mentioned there around some of the support mechanisms, and what I've done today is I've really split that up into individuals and business, and then we're going to stem into areas like superannuation, retirement. So the first initiative we'll do is look at those which have been squarely aimed at individuals and also businesses more broadly. Now, the first of these, which was related to an announcement way back now on the 12th of March, was a stimulus payment. Now, it was originally offered as a $750 tax-free payment, and it was increased just 10 days later to become 2 separate $750 payments, with pensioners, Social Security, Department of Veterans Affairs, and other income support recipients the benefactors of this particular benefit. Now, the first payment has actually already been made, so recipients should already have this money in hand. Now, as with a number of the initiatives we'll go through at the moment, there was actually no need to do anything. This was something which was automatic and paid straight through to individuals that would otherwise have qualified for this particular benefit. The second payment too, it will be automated and it's expected to be made around the 10th of July. Initially, it was the 13th of July, but one of the constants, as I mentioned at the moment, is change. And in fact, many of the fact sheets that the governments are actually putting out through Treasury are being updated on a very regular basis. In fact, in preparation for today's session, the fact sheet around some of these initiatives changed just 2 days ago. Now, these payments will be exempt from tax and will not count as income for the purposes of Social Security and Veterans Affairs type payments. Now, if you're curious around the eligibility for this particular stimulus payments, it's not quite straightforward. While it would seem that there are two payments which may be payable to each of these particular recipients, Social Security, DVA and others, there are actually fewer people that are likely to be entitled to that second stimulus package. In fact, the government estimates that over 1.5 million fewer people will receive the second stimulus payment. Now, this is due to an eligibility for a different payment called the coronavirus supplement, which we'll look at in a moment. But to make this simpler though, what I've done is broken down each of these stimulus payments into two. So if we look first at the first one, you can see quite a large list of eligible recipients here. They're ranging from age pension, disability support pension, through to New Start, youth allowance, and many others. Now, some of the other considerations here is recipients need to have been residing in Australia and been receiving one of these entitlements or concession cards between the dates of the 12th of March this year and the 13th of April. Now, if you're wondering about those clients that maybe you've perhaps assisted in applying for one of these entitlements or pensions or allowances, there is some good news here. The government will backdate this first stimulus payment to anyone who applied during that period and was subsequently granted approval to receive some of these benefits. Now, as mentioned, the recipient list for the second payment is not quite as comprehensive. And what I thought I'd do is just sort of share with you those that actually are exempt from the second payment. And this is them here. So it's people who are likely to receive a job seeker payment, youth allowance, parenting payment, among others. Now, if you're thinking, well, this doesn't seem quite fair, it's not all bad news. As I mentioned, those that miss out on this second payment will get a further financial boost through what's been called the coronavirus supplement. So let's have a quick look at this particular benefit. So the coronavirus supplement is a temporary supplement and it is payable each fortnight and it's likely to run for the next 6 months. It will be paid at a rate of about $550 per fortnight and it will commence from the 27th of April. Now, it's going to be paid to both new and existing recipients of job seeker, youth allowance, parenting payment, off-study, ab-study living allowance, farm household, and even the special benefit. New applications can be made with an application for job seeker, which, as you may know, can now be done online or on the phone for those applicants that don't actually have internet access. Importantly, though, and this is perhaps one of the advice considerations that we're going to look through, those that are receiving employer entitlements, including things like annual leave and sick leave, even income protection insurance benefits, will not be able to access this coronavirus supplement. It is actually incumbent on new applicants to really declare the fact that they are actually getting these particular benefits at the time that they apply for this particular supplement. Now, there has been an expansion of the eligibility for the coronavirus supplement via the expansion to the income support payments. So what we've seen is the asset testing for job seeker payment, youth allowance, parenting payment has been changed. There's going to be a waiving of a lot of the periods with regards to the coronavirus supplement. Now, many of these periods, some of you may know, are things like the 1 week ordinary waiting period. So that's been waived. The liquid assets waiting period, that's also been waived, as has the seasonal work preclusion period, which sits at around 6 months, and also the newly arrived residence waiting period, which can be as long as 4 years. That's also been waived. Income testing, that still remains as is, and it obviously applies then to particularly where there's other income that perhaps a partner may be receiving. Now, there's also some good news when I look through some of these waiting periods. If you've currently got clients that are undertaking, particularly the liquid assets waiting period, there has been some relief granted. So it could be a great opportunity for you to reach out to these clients to let them know that they no longer need to wait through that liquid assets waiting period and that they can then sort of move forward and apply for that particular benefit. If you're dealing with the high-end recipients, though, particularly those clients that may be sitting through a compensation preclusion period, there's been no waiver of those folks. Unfortunately, any of those periods won't be relaxed. Clients will still need to sit and actually undertake those waiting periods. So one of the big ones announced on the 30th of March, the JobKeeper payment. I thought this was really quite a game changer. As you'd appreciate, many of you being in small business, the costs associated with staff really is or can be quite a significant portion of a business's total spend. And really what the JobKeeper payment has been designed to do has been to allow certainly the cost of maintaining staff to be somewhat managed, but also I think for businesses to retain that critical connection that businesses have with their key staff. So ultimately trying to really lessen that financial disruption throughout this crisis, and in turn, potentially quicken the rate of recovery for businesses without having to spend more time hiring staff when things start to get back to a little bit of normality. Now, as you may know, the JobKeeper payment, it is paid at a fixed $1,500 per fortnight. It's payable for eligible employees from the first week of May, so it's still a couple of weeks away yet, with eligible employees being those who are full-time, part-time, and it has also extended to fixed-term contractors. Now, there has been some clarity too recently around long-term casual workers. These have also been included, provided they've been with their current employer on a regular basis and a systematic basis for at least 12 months. And that was as at the 1st of March this year, 2020. Now, eligibility for employees extends not just to citizens, but to permanent visa holders, and also New Zealand citizens that hold a work, or specifically that 444 subclass visa. Now, for those employees who have multiple jobs, and I know this is a question that many of our team at Zurich have actually fielded, how it works. You know, clearly they're not going to get several bites of the JobKeeper payment, and that is true. What the employer will need to do is notify their primary employer to claim that JobKeeper payment on their behalf. And it's understood that generally the employee that is claiming the tax-free threshold from that employer, they're likely to be the ones that are seen as that primary employer. So they will be the ones to actually speak to in relation to getting access to this particular payment. Now, the JobKeeper payment is available from the Australian Tax Office, and despite being advertised as being paid as a fortnightly amount, it will be paid monthly in arrears. Now, with regards to business eligibility, and if this is something that might be of interest to you and perhaps your small business clients, it extends to sole traders, with businesses needing to have had what's being termed as a sizable reduction in turnover. Now, for businesses with a turnover of less than $1 billion, a B for billion, the turnover reduction needs to be more than 30%. For businesses whose turnover is more than $1 billion, the reduction is 50%. Charities, not-for-profits, theirs is a little bit more generous. So they need to have experienced a drop by 15% or more. Now, these eligible businesses will need to register with the tax office, initially just with the business name, ABN, contact name, email, phone number, I think is all that's needed at this particular point in time. Now, employers will need to notify their affected employees if they are claiming for this fortnightly payment. Now, one of the other common queries that we've seen come through relating to JobKeeper is for employees that are not actually earning the $1,500 a fortnight and how that actually works. So what the government's basically stipulated is, and this has actually only come out very recently in a release which is called the Coronavirus Economic Response Package Payments and Benefits Rules of 2020. It's a bit of a mouthful, but if you're wanting to Google that, it's once again Coronavirus Economic Response Package, and then in brackets, payments and benefits, close brackets, Rules 2020. Now, what this document stipulates is that the condition of entitlement is that the businesses have paid a salary or wages of at least $1,500 to the employee in a fortnight. So for those staff that have actually earned less, what the employer needs to do is actually put through a top-up gross payment. And this is something, it's kind of like ordinary wage, if you're familiar with that system, where through what's called the STP or single touch payroll system via the ATO, this employee will then be eligible for that full $1,500 payment before tax. And the reason for this, really, there's actually no lower payment. So people that are on a lower income don't get a lower entitlement to that JobKeeper. It is a fixed and flat $1,500 payment per fortnight. Some of the other areas of uncertainty relate to people on income support and what this means for job seeker payment. Now, as you may know, there's this newer type contract, newer program called Job Seeker with an S, and it replaces the former New Start and sickness allowance benefits, among others. And what we know is that this is now going to be the main income support offered for those who are really looking for work or can't work due to illness or accident. So if you do have clients that have lost their job as part of the impacts of COVID-19, and they've already taken those proactive steps and started receiving income support payments through the Job Seeker payment program, what they need to do is, as soon as they find out that there is an eligibility from their employer and that they're going to be receiving this JobKeeper payment, they need to cancel that Job Seeker payment entitlement, as though what they could do is actually incur a debt, and any overpayments needs to be repaid back to the Commonwealth. Also, folks, the other interesting element of these new type programs is that there is some age consideration. So if you're dealing with perhaps children of clients, or you're dealing with younger clients as part of your demographic, or you've got kids yourself, there are some differences with respect to ages, certainly between the JobKeeper and the Job Seeker payments. So the minimum age for the Job Seeker applicants, so this is, again, this New Start sickness allowance, the minimum age is 22 years of age. People that are younger than that will need to apply via the youth allowance type program. The JobKeeper is actually much younger. So the age to qualify is those who are aged just 16 years of age, as at the 1st of March this year. So this is no doubt going to target a lot of younger Australians working part-time, working casually, particularly for many who are not earning anywhere near that $1,500 a fortnight benefit. They are actually going to be entitled to this JobKeeper payment. Now, in terms of businesses that don't qualify, this is also something which we fielded a few queries on. The businesses that are not going to qualify for the JobKeeper scheme are those which are part of the major bank levy, which is part of another government arrangement that's in place. Those of a governing body, like a local governing body, those of a sovereign entity, and also those companies, perhaps those which have a liquidator or provisional liquidator that's been appointed in relation to that company, or equally individuals where a liquidator or provisional liquidator has been appointed to the individual's property. So those particular entities are unlikely to be eligible under this JobKeeper program. If you're worrying about, well, what about perhaps some of those clients that might be receiving, say, their income monthly, not fortnightly, how does that work? In that particular document, that coronavirus economic response package document, what the government has clearly laid out there is it's going to be fair and equitable. So it'll just be worked out, those monthly amounts based on a fortnightly equivalent, and it'll just be simply applied to those particular periods. The other one I noticed that have come through, and I noticed there's a few questions already coming through, which is fantastic, keep them coming through, relates to turnover. So what does turnover mean? How does turnover work? What the government has stated is, in relation to the determination of what relates to turnover, it's linked back to the business activity statement. So things such as taxable supplies, GST-free supplies, they all form part of what is deemed turnover, but anything that's not input taxed, those don't actually qualify under that particular figure. So hopefully that gives you a bit of guidance, particularly for those businesses that may be on the cusp of some of the figures that the government have actually stipulated. Now, before we move on, just see if there's any other questions that have kind of come through here. So one from Karen, thank you, Karen, mentioning employers needing to notify employees. So this is a very interesting question. It's a little bit grey at the moment, but there does seem to be almost incumbent on these employers to sort of take the first step and actually apply. The government has pitched this as a benefit for employers in retaining key staff and their ability to continue, with ultimately the benefit being payable to those end employees. So if you're finding that employers are being somewhat lackluster in saying, look, hey, we're part of this program or not, it may be worthwhile perhaps advising your clients who are employees to really start pushing that and driving it back with their employers to say, look, we feel there's an entitlement here. What's the latest? Are you applying for it? So thank you. Please send these through these questions, folks, as we come in. I'll again try and maintain an eye on them as we go through. Now, in addition to the JobKeeper payment, support for business, cash flow boost for business. So this is something else which I think is going to make or certainly take a lot of the income burden off many businesses. So this relates to small and medium businesses, including not-for-profits. Also sole traders, partnerships, companies, even trusts are eligible for these cash flow boosts. Now, part of the requirements here is that they must have an ABN, clearly, and that ABN needs to have been active on the 12th of March this year. So I'm not quite sure why there's so many variances in dates here, folks, but they are certainly what they are. The businesses need to have continued to be active from that date. They need to have had an aggregated annual turnover of under 50 million. And again, this is generally based on the prior year's turnover, and have made some sort of eligible payments that the business is required to actually withhold. So eligible payments, these are things like salary, wages, directors' fees, and the like. Now, businesses need to have effectively derived some form of business income and lodged a 2019 tax return on or before the 12th of March. But for those businesses that have not actually done that, the alternate is they need to have made some sort of GST taxable, GST-free input tax credit on an activity statement on or before that date, that 12th of March date, as long as it's done since the 1st of July 2018. Even if these amounts are zero, that's also okay. The way this particular system works is the initial cash flow boost will be based on that amount of the PAYG withheld, and it's going to be 100% of that amount. Now, if you're wondering how does it work if business has not withheld anything, they'll actually be entitled to a minimum of $10,000, but the maximum capping of this particular payment is $50,000. So from June, those who have received initial cash flow boosts, they'll receive an additional cash flow boost for the period June to September, based on the amount of the initial cash flow boost that was received in this financial year that we're in right now. Quarterly instalment lodgers will be able to receive about half of their initial boost based on that June period and half September. Monthly instalment lodgers, because they're doing it more frequently, this is going to be smaller but higher. So it's going to be 3 times that amount. So for June, July, August, September. These boosts also, folks, they're not subject to GST. The other interesting increase, which I don't think has had much airplay, but I thought was a particularly attractive incentive and also time critical, I think, folks, if you're perhaps working with businesses that are looking to really bolster their position prior to the end of the financial year, is the instant asset write-off threshold increase. So this is something which businesses, some 360,000 businesses each year, do maximise as part of their deduction strategy. And what they really do is typically provide asset write-off on a level of about $30,000. Now, as part of the COVID-19 situation, this has been drastically uplifted to $150,000. And what this really does, it allows for the immediate deduction of both new and also second-hand assets which are purchased, and the limits apply on a per asset basis. There are certain business assets excluded from the write-off threshold. There's not a lot, to be honest, folks, but there are things like horticultural plants, such as maybe grapevines used in vineyards, that sort of thing, as well as assets which are likely to be used primarily, or at least 50% of the time, on a lease out type basis. Now, while these assets that I mentioned don't qualify for this particular, the instant asset write-off, what happens is the usual depreciation rules apply to those particular assets. Now, unlike, and this is pretty important, folks, unlike some of the other announcements that we've seen, this particular one around the asset write-off, it's very much time limited, folks. So it's looking to change from the 1st of July this year, and it's not going to be going back to $30,000, but dropping to $1,000. So if you think about that for a moment, prior to the COVID-19, it was 30. It's been dialed up to 150,000, but from July at this stage, it's likely it's going to go just to $1,000. So this could really be a significant opportunity for your clients who are really looking to, as I say, maximize perhaps their business spend prior to the end of the year, which is the 2019-2020 financial year. It's also important to note that if you want to know more about how this works, it's not a case of businesses just purchasing a particular asset. What it does generally mean, it needs to be at least installed or ready for use prior to 30 June. So it effectively means that if someone was to, an approved installer, for example, was to install it in July, it actually may render that particular asset unable to qualify for this particular deduction. So it's a particularly important point to note on that front. Now, the other support for business here, and it's also a deduction initiative, is the Backing Business Investment Incentive. And really what this is designed is to really fast track some of the asset deductions. However, while the instant asset write-off applies to new and second-hand assets, this one is a little bit different. So this only relates to new assets that are purchased only. Now, while that's not quite as good, there is actually a benefit of this scheme over the old being the instant asset write-off, and that is that the Backing Business Investment Incentive is actually going to be running for a longer period. So there's no kind of, not necessarily a speed issue here, that businesses have up until 30th of June next year, so 2021, to actually qualify for this particular deduction. So if you're looking from a speed perspective for your clients, it certainly would be the instant asset write-off over the Backing Business Investment Incentive. Now, an interesting element here is that, and I say interesting because I feel that there may be some businesses in particular that were already struggling long before this particular pandemic became an issue. And it's nice to see that many of these businesses are not necessarily being forgotten. So what the government's actually announced is a temporary relief packages for what has been deemed financially distressed businesses. And really what it allows is situations where perhaps creditors are really wishing to issue a statutory demand on a company, or maybe a creditor is looking to initiate bankruptcy proceedings. The minimum threshold was previously around $2,000 and $5,000 respectively. These have been lifted temporarily to $20,000, so there's a bit more room there. Equally, the time frame that usually applies for a debtor to respond to these sorts of demands, so a statutory demand or bankruptcy notice, along with protection periods for situations where creditors can actually take action to recover debts. These were sitting at around 21 days. These have now been increased, albeit temporarily, to 6 months. So while this is good news for those debtors who are struggling, there may be others looking to recover debts where this is perhaps not such great news. And in these situations, these creditors do still have the right to apply through the courts, despite raising any of these sorts of particular time periods. So there are still some avenues available to those that may not be able to necessarily wait those 6 months for these new periods in time to actually kick off. So that really finishes off the support specifically for individuals, for businesses, and hopefully this provides a bit of insight, a bit of opportunity perhaps for many of your clients that are perhaps looking for questions out there. So I thought it might now be prudent to look at some of the superannuation and retirement measures. Now, just while we're doing that, certainly many more questions coming through. Lynn Hazeman. Lynn, hi, thank you for joining us. So we're seeing grandfathered income drop off in May and new business is very low. Turnover will be affected. Cash flow as well, agreed. What period is a turnover compared to? So information at the moment seems to suggest information, so the turnover related to the previous period, so last year. But from what I've been reading, what we understand is there seems to be a level of opportunity if your situations are somewhat unique. So there may be an opportunity to sort of discuss your situation in a bit more detail, and that might be able to provide a bit of relief for your particular situation. So let's now look through some of these super and retirement measures. Now, these are certainly likely to spark some queries, some questions from many of your clients. So if we look about further measures, the early access to super is certainly one of them. And this is something which is certainly another method for clients to really provide financial support during this COVID-19 period. And it is via, as you may know, an early redemption to superannuation savings. Eligible members can get access to up to $20,000. And as you know, this is available over 2 distinct periods. So this window of opportunity runs for just over 6 months, about 186 days. The first period commences next week, so Monday the 20th of April, runs through to the end of the financial year. The second period kicks off from 1 July and it runs through to, at this stage, the 24th, Thursday, the 24th of September. Eligibility is restricted to those who are either unemployed or entitled to one of the designated support payments. Perhaps if people don't qualify under those, they'll also extend eligibility to those who, since the start of this year, 2020, someone who was either made redundant or had their work hours reduced by 20% or more. Sole traders too, that 20% limit also applies to them, but they also need to have had, if the 20% doesn't apply, a level of suspension with their business. So the business has suspended as a result of this particular COVID-19. Now, in terms of the provisions for advice for these particular clients, you may have read the announcement this week from ASIC, and Phil mentioned this in his introduction earlier today. But for those of you that are not yet across these details, I think it was the 14th of April, what ASIC did is they issued a media release detailing what they have termed advice-related relief in the provision of advice for these particular clients that you're assisting, specifically with regards to the early access to super. ASIC have already issued an instrument which they've deemed the corporation's instrument, which is number 2020/355 if you want the details, but it effectively amends section 946C of the Corporations Act. And what it does is it extends the time frame applicable for providing time critical advice. And what it's done, it's risen from 5 to 30 days. So it does give you a lot more time to be able to qualify under those time critical advice guidelines. In addition, for those clients that are seeking advice about, again, about this early access to super, the reading through this ASIC document, it looks as though you don't need to provide a statement of advice. A record of advice is looking like it may actually be sufficient. If you've read through the details, you may also see that any advice fee charged around this particular transaction itself will need to be capped at $300. And the client must have approached you or their advice provider for advice on this particular element. So ASIC has gone to illustrate that what they've deemed as unsolicited contact with a client in relation to the early release of these particular benefits is expressly exempt and will be subject to the normal advice provisions that you would typically provide. Now, if you're wondering about the situations where there's clients that have personal circumstances and maybe they've clearly changed as a result of this COVID-19 pandemic, or maybe a client seeing perhaps a different advisor in your business, or maybe a different advisor as part of the licensee, there has been an exemption applied to section 911A of the Act, and it does allow a bit of leniency in terms of being able to apply these ROAs and time critical advice. Interestingly too, this 911A, what we've seen is that it extends through to registered tax agents, which is interesting, giving people who are neither a financial services licensee nor a representative of financial services licensee an exemption to actually provide COVID-19 advice into getting early access to their super. The similar restrictions though do apply to these particular individuals where unsolicited contact is not allowed. The fee cap, $300 per transaction, also applies. Now, before you consider taking action, please do make sure that you speak with your own licensees, check in with them just to make sure that these announcements in their entirety do make through to your own license. Now, some of the other elements here for the temporary early access to super I thought might be noteworthy here, again from an advice considerations viewpoint, were things like what people can actually do with the proceeds. And as you can see here, it's pretty much just a Q&A type arrangement. But these are some of the queries that we've also fielded through to many of our team at Zurich and OnePath. In terms of tax implications, there aren't any, there's not going to be any tax implications. In terms of restrictions on use, unlike some of the early access schemes that we've seen, like the First Home Super Saver Scheme, there's no restrictions on the use of the proceeds from member super. So clients wanting to take 10,000 now and 10,000 from 1 July, they're actually able to utilise those proceeds as they see fit. Each application, though, for the withdrawal, it is assessed individually. So what you'll see is a change in circumstances, say after 1 July, may render that second payment being inaccessible in that second time frame. What we're also noticing is there appears to be guidance that no subsequent withdrawals are likely to be allowed within the time frame. So if clients lodge an application today for say $5,000, and then in May they decide, well, really I need to get another $5,000 out, that's not likely to be available. What has to happen is a reassessment will need to take place, and it'll have to take place in that second period. So clients will need to make sure that they need to apply just for one determination per financial year. It can be done through multiple funds though. So you can take 1,000 from one fund and 9,000 from another super fund, as long as it's within that same determination and that same application. Now, if you do feel that you've got clients that may not tick the right boxes in getting early access to their super, there are a number of other options which may be available. This includes gaining access to super via compassionate grounds. So not just for the super fund member, as you may know, but also for a dependent, for a super fund member's spouse, or a child of that particular super fund member, including those in an interdependent relationship. So there may be an eligibility there, so long as they're providing its 3 criteria: personal care, financial care, and domestic support to each of those. Compassionate grounds, it can include necessary medical treatment. It can include medical transport expenses, not just for you or for for that particular super fund member, but also for that member's client, for their dependent, as I mentioned. It can be for the treatment of pain, for mental illness, so long as they're either acute or they're chronic. It can be for illness or accident, as long as it's deemed to be life-threatening. It can also extend to property retention, but I'd use the term severe. It does need to be classified as severe. So if a lender is threatening, say, foreclosure, or council rates are sitting at around 2 years in arrears, they're likely to qualify. But if it's a case where there's an outstanding loan repayment, or there's not really a risk of foreclosure or a forcible sale, it's highly likely that they're going to be unable to apply under the compassionate grounds. Equally, clients that you may be working with that are looking down the barrel of bankruptcy, or maybe family court proceedings, it looks as though they are also ineligible under the compassionate grounds. In addition to compassionate grounds, severe financial hardship is another area. This might be something particularly for those clients who are receiving government income support and have done for at least 26 weeks. And if they're not able to meet what's classified as reasonable or immediate family living expenses, they may be eligible to qualify. Now, granted, those that get access under the COVID-19, things like this tax-free treatment, those same generosity in terms of tax treatment doesn't extend to compassionate grounds severe financial hardship. Now, there could be some complications in gaining access to super. Of course, perhaps the most immediate that would jump to my mind is the longer term impact on retirement savings. But another one relates to the potential loss of insurance benefits. If, for example, a super fund mandates, say, a minimum balance in a particular fund. Now, it's important to note here, folks, that the balance requirement, it can differ between funds. And I know many of you are probably aware that there is that $6,000 minimum standard which does apply, but a number of different super funds have taken it upon themselves to actually apply a higher level of minimum balance for their members. Not only that, you may find that some funds apply a different minimum balance based on, say, the life and TPD compared to the income protection. So if we use an example, a client may have $10,000 and is looking to take out, let's say, $2,000, so keeping it up above that $6,000 limit. You may find that with some funds, the life and TPD may be okay, but the income protection may be affected, may be impacted. So please be mindful, depending on the super funds that you're doing research on, just double check the minimum balance requirements, not just for insurance broadly, but against each specific component of that insurance contract. Now, not just the accumulation phase, but we've seen in terms of the minimum, the retiree space changes here. So just keeping an eye on time here, folks. The minimum drawdown space. So what we've got here is a bit of a relaxing in terms of the amount that's actually able to be withdrawn from the likes of allocated pensions, account-based pensions, allocated annuities and like. So this is effectively halved. So if you've got a 65-year-old previously drawing the 5% minimum, it can now sit at just 2.5%. So if they're getting additional income support supplements through COVID-19, or maybe just trying to minimize the volatility aspect that clients have perhaps currently been suffering, then this might be a terrific way of being able to actually limit some of the downside. Equally, those clients who are income test affected perhaps would have seen a bit of an uplift in terms of their benefits very recently, with a 75 base point reduction occurring both at the lower tier deeming rate, which was previously 1, it's now 0.25, and the previous rate of 3 for that higher threshold dropped from 3 to 2.25. So that's certainly helping the retirees there. So really, just looking, it does look like we're almost out of time here, but I did want to make sure I leave this with you folks. So support materials, we have covered quite a bit of ground today. If you are looking for more, at Zurich, what we've put together is quite a number of fact sheets which are available, which do cover many of the things that we've spoken about today. From an investment standpoint, if you're looking for more insights on volatility, our head of savings and investment, the amazing Matt Drennan, he's put some poignant commentary together, which I've actually had a read through. It's really, really good. And if you do want some information to maybe just to help the discussions you're having with clients, please make sure you get access to that. And we've also got a digital support pack ready, and this might help engaging with clients who are not quite so tech savvy. So we've got a new virtual office webinar series which you can gain access to. Now the way to do that, 2 ways you can do it. One is to head to zoneeducation, one word, .com.au, register there, or speak with your Zurich or OnePath representative, and they'll be able to help you through getting access to it. But folks, look, I do hope that that was of benefit to you today. Thank you so much for joining us, for your participation, for the questions that have come through. I'm happy to take more questions if we have time, but I'm worried that we might be kicked off shortly. So I don't know, anyone at the AFA wants to have a comment that may be listening?
You have time for questions, Adam.
Perfect, Phil. Yep. Just having a look through here. So thank you for sending them through. Just looking here. So Ian Finney, thank you for your message here. Having some trouble getting onto the website to register interest. Excuse me. Not quite sure what you might be referring to there, Ian, if it's the JobKeeper payment, if it's from an employer perspective. I do know that they were having some issues with respect to online access. That was around a week ago now. I was under the impression that those were sorted, but I understand there might be a couple of different avenues that are available. So if you head to treasury.gov.au, I found this a particularly useful resource for a lot of the information you've seen today. You may notice the source references, not just for getting access to this info, but very current information. As I mentioned, I think one of the fact sheets was updated just 2 days ago. So again, just that point of note, if you are preparing advice documents for your clients, even an ROA, it could be really beneficial just before you hit print or send on that document, just to go back into that treasury.gov.au and make sure there's been no amendments to that particular package support material that they might be offering. Someone I see here, anonymous, the state-based financial assistance in Victoria. So thank you. Is there one available to business in Victoria? Look, I'd be really interested, folks, if you've got, or you're well aware of your own state or territory that might be doing some sort of benefit. I was reading the WA and South Australia benefits this morning, just to see if there's been any change to those. But has anyone found anything that might be of use? Please feel free to look. I think the comments spot is a great spot to do it. Just obviously clearly mention the state there, so others might be able to sort of, I suppose, peg a question based on that. But Yeah, that New South Wales one, again, is the Small Business Support Relief Package, I think it's called. But I just thought the fact that they mentioned financial advice specifically was highly unusual. And I thought a real talking point, not just for clients who have businesses based in New South Wales, but maybe, as I said, for other states who might want to use the example of New South Wales to maybe look at extending that further. One question I know that's been asked about that is, what's the limit in terms of how much for financial advice fees? Great question. There's not been one. The only information we know so far is the actual package is capped at 10 grand, but it needs to be used for those kind of unavoidable business expenses that the government mentioned. A lot more questions coming through, which is great. Paul, thank you for your email. Do we have a hard copy of the presentation? I understand that the AFA is going to be uploading this potentially to the website. So while that may not be able to give you access to a hard copy, I think one of the things that we're doing at Zurich is we'll be uploading potentially this particular presentation, or at least a variation depending on the recording and how we've gone today, into the Zone Education website down the track. So if you've got maybe colleagues that missed out on attending today or couldn't join us and want to get access not just to the information but the CPD points that will accompany it, I'd urge you please to go to that zoneeducation.com.au website, get them to register interest, and they'll be able to listen to this particular session, get access to information and also the CPD points that it provides. Comment there from Peter Stathis. Thanks, Pete. Appreciate that very much indeed. Accessing super was a question that came up. Not a lot of information on that one, Ian, but yeah, so look, folks, thank you very much once again for your time today. I really do appreciate your attendance. It is very much a movable beast, so hopefully the information that we're provided today is current as at the now. It certainly could be subject to change, but it is such an amazing environment for, I think, advice moving forward. So many questions, so much complexity around this that I really do hope that it does see a great uplift in the need for advice and quality advice being given to your clients. So thank you very much for your attendance, and I look forward to speaking with you again soon.